business facilities in continents as varied as Africa. He was involved with the setting up of a joint venture entity in India for WeWorks. A very wide experience, and typically the reason for approaching Mr. Joshi is to understand the practical aspects of real estate valuation. Most of the theoretical subject we get it on in books, but when it comes to practical aspects, this is where I draw a lot of inspiration, a lot of knowledge from Mr. Joshi. I thought it would be a good BVA would be a good platform for disseminating this knowledge. With this background, I leave the floor open to Mr. Joshi. Mr. Joshi, all yours.
Uh, Good morning to everybody, and Uttam, thanks for this introduction. Very kind of you to tell this to everybody. Let me not, spend a lot of time on general stuff. Let me start with the presentation straight away. I'm not a great orator, but I'm going to speak my experience, and wherever possible, please chip in and share your views, and if please you can raise it at appropriate stage. Uttam, only one, just a question. Will the questions be directed to you, or it will be straight asked to me?
You just have to keep a watch on the chat box. Some of the questions would be there in the chat box, and yeah, wherever required, questions would be directed directly to you.
Okay, I'm not sure whether I'm as comfortable in the chat box, but will you be also be able to see those chat box?
Definitely.
Okay, so you can always let me know in case I have missed out any questions. Thanks a lot.
Sure.
Let me share my screen. I have a separate monitor, so please bear with me. You may think I'm watching somewhere else, but it is the monitor that I'm watching. Can you see my screen, please? Yeah. 1 second. Let me put the slideshow. I believe this is the full screen. So I'm going to, my focus area would be mostly on the key terms of valuation factors or assumptions that are used in valuing real estate and various methods of real estate. But let me quickly touch upon what exactly is real estate, real property, price and market value. I'm sure every speaker would be talking about it, so I'll not talk a lot on that. Then what is the need of valuation is also what we'll do. And then definitely my last 3 pointers that I have listed down. Quickly, what is real estate? Simply to put, it's the land on the surface of the earth, above the surface of the earth and below the surface of the earth, and everything that is permanently attached to the land, whether artificially or it could be naturally. Now, when I say artificially, you construct buildings, and that will also be part of that real estate. If there are timber grown on the land, then that also will be part of real estate. On the other hand, real property is a much wider term. Real property not only includes real estate, what I right now define, but it also includes the right benefits attached with the real estate. Let's say it gives you a right to lease, it gives you a right to use, it gives you a right to sell it, or it gives you a right to raise a loan against that property. That is also part of the definition of real property. So let me talk about price and market value, and then let me launch few questions about real estate, real property, or market price and market value. Now, like any other asset, price of a real estate is the price, actual price that you are paying for buying or selling a real estate, whereas the market value is the estimated price that you are willing to pay to buy or sell a real estate. Just to look at the definition that is being given by International Valuation Standards Council and that has been adopted by RICS. What is it? It is the like any other asset. It's the estimated amount for which a asset or liability would exchange on the valuation date. Obviously, it is relevant as on the valuation date, and it is exchange between a willing buyer and a willing seller at an arm's length transaction after a proper marketing is done, where both of them have acted knowledgeably, prudently, and without compulsion. I'll not dwell more on this. I'm sure every speaker talks about it. So let me go ahead. But before we go ahead, just that I keep you engaged, I would launch a couple of questions as and when we go, instead of doing it at the end. Let me do that so that you guys are actively engaged with me. Could you guys? Uh, yeah, you got the questions, right? If you have any questions till this point in time, you can raise, or you want to do it later on also, that should be fine. A few more to go, and then uh, should I end the poll? There are 3 more people to answer it. I can end the poll, right?
Yeah, okay. You can.
Yeah. So I'll share the results. Now, what is a real? Like I told you, real estate is a subset of real property, not the other way around. So the first answer is not correct. It is not just the land, but it also includes the interest, benefits, and rights of ownership of real estate. So point number C is the right answer. Now, I would launch the second question also, so that Uttam, I should relaunch polling. What do I do for the next question?
Select from the drop down arrow.
I'll select from the drop down arrow. Yes, perfect. Yeah. So what is the market value of a real estate? Is it lower than the price, higher than the price, equal to the price, or it is the estimated price of the real estate? Yeah, everybody is giving the right answer. So it is, as I said, it is neither higher nor lower, but it is, and not even, it is the price, it is the estimated price of the real estate, where the willing buyer and seller, would exchange the asset. So point number D is the right answer. I stopped the share of this. Sorry, but can you see the screen again, or I need to show it again? You guys can continue. You can see the screen, right?
Yes.
Yeah. Okay. I'm not able to move this. Yeah. Okay, let's get to know why you value a real estate. Like any other asset, you carry out valuation for a particular purpose. There has to be a purpose of valuation, and that's what you mention in your valuation report. There are various purposes for which real estate would be valued. Um, let's say what is a common instance that everybody must have come across. Generally, when you're trying to raise a loan for buying a house, there would be a surveyor who would do the valuation of the real estate for the banks, because they would like to know what is the quantum of loan that the bank can provide. The bank has to maintain a loan to value ratio, and they need to have a proper mortgage. And if asset is not valuable, they would not like to lend money against it. So you carry out the valuation. Similarly, there are other participants in the market who would carry out the valuation. So the objective of valuation is to find out what, let's say, a lender would find out the valuation of real estate property to lend the money, whereas there could be a property developer. Let's say he wants to enter, he finds a particular land uh, which can be exploited commercially, either by doing a residential development or a commercial development. Now he wants to buy that land, and to buy that land he will carry out the valuation of that property and then go to the seller and express his interest, and he will be willing to pay a particular price. To estimate that price that he is willing to pay, he will carry out the valuation. Or he would feel that the land is kind of very expensive, so he would rather enter into a joint development agreement. Even in case of a joint development agreement, whether it makes sense for him to give him a particular share, whether he ends up giving a 30% share or a 40% share. I'm sure everybody is aware of a joint development arrangement. Here, what happens is the land is owned by a separate person, whereas the real estate developer would not like to pay for the land, but he would in turn go to him and say that I don't want to pay you for the land, but what I can do is I will construct your share as well as my share, and because you have given me this land, I will give you a certain portion of the constructed area. So even to estimate that, you need to carry out the valuation of the land. Again, a commercial property is ready and the property developer is in need, like you must be seeing in the news and articles that you must be reading. There are a lot of property developers in Bangalore have been selling the property. You might have heard recently that Embassy has sold one of the largest parks that it had. Prestige has been selling a huge list of assets. Similarly, RMZ in Bangalore has sold their assets to Brookfield. So before they do that, they would like to understand what would be the valuation of that property, and accordingly they would engage consultants to value the real estate property. So the people who would carry the valuation of real estate could be the lenders who want to lend, the property developers. There could be private equity players like Brookfield, Blackstone, KKRs of the world, who will also like to carry out the valuation of the real estate property. Let's say they want to invest with an investor, with a landowner. The landowner has 7-8 land parcels. So now they would form a joint venture, and all those lands would be put into the joint venture. And now the private equity player is willing to put in 50% money for is willing to acquire a 50% share in the joint venture, and to find out what price he needs to pay, he'll carry out the valuation, and basis the valuation of the property. Let's say if he wants to buy 50% stake, and the property developer wants to sell his 50% stake, then he will get the valuation done by real estate experts. Either the money will come inside the SPV or it might go outside the SPV, and accordingly the stake would be worked out. Similarly, when you are selling a house, let's say the property developer is selling the house, he would try to find out in the locality where the development is coming up as to what price the residential houses have been sold, the flats have been sold, and he'll make use of the valuation methodologies to find out what should be the right price of the apartment, and accordingly he will appoint consultants to work out the valuation, or he may have in-house consultants. Like today, I am sitting with a real estate developer, and earlier I was like you guys used to carry out valuations of companies in variety of sectors. Today, I sit inside an organization and either appoint external agencies like you, or might sometimes do in-house valuations. Anyways, like any other asset, as I said, you need to accurately estimate the market price of the asset, in this case, the real estate, after considering various factors. What are those factors? We'll look it into in the subsequent slides. Let me launch one more question and see if you can answer that. Why would a lender carry out the valuation of real estate? Okay, I'll end the poll. Yeah, he will do it for carrying out. I mean, all for the objective would be all A, B, and C, so all of the above. Yeah. Okay, let us understand a few key terms that are quite common while you carry out a real estate valuation. Generally, somebody who is into real estate sector will definitely know this, and everybody has one real estate. Either he's owning it, or he might have been he might be taking it on lease, but he is using a real estate either in the form of a residential house or an office. So I'm sure many of you must be already aware, but let us understand the technical terms, how they are understood in the real estate valuation parlance, and get going with it. So what's the gross rent? Generally, it is expressed in terms of monthly rent. However, you can always mention it in quarterly or annual, but in the normal parlance, it is expressed in a monthly format. For a residential house, it is the total rent that you end up paying. But generally, for a commercial building, it is expressed in terms of let's say 70 rupees per square feet per month. That is the rent that you end up paying for using that residence or for using the commercial building. There would be charges over and above that, which would be for a residence. There won't be any parking fees, but for commercial, definitely there would be parking fees, and you will also end up spending on the maintenance of the common area. Maintenance is also spent depending upon the agreement. If the landlord has agreed to pay it himself, then it would be part of gross rent. Otherwise, not typically, it is not part of the gross rent. As compared to gross rent, what is net operating income? Net operating income, this is a very important term. I think let us read this first and understand, because there are several valuation techniques which are dependent on the net operating income. A net operating income associated with the real estate Typically, you do it for a property which is leased out, and it is nothing but the rental in the gross rent that we saw above of the property, less all the expenses relating to its ownership. Sometimes it's an investor owner and he would have appointed an agency who will take care of all these expenses, or many occasions it would be the real estate developer, he himself would be carrying out all these expenses. But yes, these expenses needs to be reduced so that you get the net operating income. What are these expenses? These are all ownership related expenses. There would be outgoings in the form of property tax, there would be outgoing in the form of repairs, maintenance, insurance, service charge. You would have appointed an agency, let's say, who would be managing the assets. So it is typically an investor owner would give it to an agency who would charge him 2 or 3% of the gross rental asset management charges, or the property management charges. That will get reduced. When you most of you are valuers and are familiar with the term EBITDA, because you carry out valuation of with EBITDA. This NOI should be before depreciation, and before you won't reduce the taxes, you won't reduce the depreciation, you won't reduce the interest payouts. Look at it as EBITDA. I'm sure you're clear with this definition. On few occasions, you also reduce when you're valuing a property. NOI is relevant. NOI is sometimes even looked at after the vacancy loss. Now, here the vacancy loss is little viewed in a different way. Let's say there is a big building and half of the building is vacant. That is not a vacancy loss for NOI calculations. There would be a building which is 10 million and in a very hot location, completely leased out, but during the entire year, there could be some point in time where somebody is relocating, or there will be some incubation space which would be kind of provided by the developer for the time being until the space is ready. So he would not be generating rent for the building, however popular that building or location would be. So typically it could be 1 or 2%, and there are occasions you also reduce that from your net operating income. But if a 50% of the building is vacant, that is not associated. That is not what is deducted from a net operating income. Anyways, what is vacancy and collection loss? Vacancy or collection loss is the loss that a real estate owner will incur because his property is either vacant or it might have been leased out, but because for some reason he has not collected the rent. Best example is current situation due to COVID. A lot of tenants have negotiated. There's a particular clause in your real estate agreements, which or most of the agreement you have, the force majeure clause, where it will give the right to. I mean, your obligations are only applicable if the conditions allow you to perform your obligations. And in this case, there were several people who were not able to use the real estate property, and they have negotiated with the owners, made use of this clause, and have not paid the rentals. So, here the vacancy loss here is actually a collection loss, where the property was already leased out, the tenant is staying in it, but because of the situation, he's not going to pay, and to that extent, the landowner is going to incur a loss. Let's go to the next. If there are any questions, you can please keep asking me. I will be happy to answer. Probably I can't see the screen. You can unmute yourself and ask, or maybe Uttam, you can direct it to Uttam, and Uttam can let me know in case, because I am little. I'm not that tech savvy to see the questions on the screen. Okay. Let me go ahead. But if there are any questions, let me know.
Hanuman, this is Subbarao from Bangalore. I have a question. I have a question on like valuation of a mall, like the shopping mall, where the owner is different, and again some people will buy the shops also, and some are on lease, and some will be given for like 10 years or 12 years. How you value a mall?
I can see. I'll take this question when I'm going to discuss the valuation methods. And if I don't answer that, point it out to me. There is a valuation methodology that I'm talking about. And just to briefly talk about, this is looked at a commercial property only. Here, apart from rent that you are expecting, see, generally in a mall, what happens is, very rare. I mean, see, a very A-grade developer will not end up doing portion sale of the mall. Whereas a smaller developer, what he'll do is, because he's in need of money, he will keep selling some units of the mall, whereas he'll retain the balance units. Uh, Whatever it might be the case, whatever is left out with the land or owner, only that is valued, because what I own is what I can value. I can't value a property which I don't own. But this is a case of a small time developer who may be in need of money and he has sold part of the mall. Balance mall needs to be valued. It is valued like any other commercial asset. Here, in case of a commercial asset, there is a simple rent that you get. Whereas in case of a mall, apart from the rent that you generate, there are other streams of income, because typically in a mall, it is a fixed rent per square feet. Apart from that, it is a revenue share. And in the COVID times, the rent is not coming because they have renegotiated with the landowners and they have told them that, look, I can't pay you and I want to change the term of the agreement. For next 1 year, I'm only going to pay you a percentage of the revenue, and they're not generating revenue, and typically they're not paying any rent. At least they did not pay until very recently. Now that people are going back to the mall, the rent, revenue share has kicked in. So there could be two elements. Let's not take COVID as an example, but in a typical scenario, it is the fixed rent that they pay. Apart from that, they end up paying the revenue share. And you won't believe, but the parking fees is almost 6 to 7% of the revenues that a real estate mall owner will look at. And that parking revenue is also an important element. Apart from that, there would be a lot of marketing events, there would be kiosks, etc., that would be set up within the mall. Even those things are factored. And typically, a mall will also have a lot of expenses associated with the mall. The electricity bill, etc., are actually collected in the common area maintenance, but there are still a lot of marketing and the sales people who are there in a mall. There are a lot of disturbance. I think somebody, you can put yourself on mute. Those are factored into, and it is valued similar to a commercial estate. What method to follow, we'll see in the coming slides. But I believe partially I've answered your question, and what method to apply, I'll let you know at the next slide.
Okay, and I have one more question, like how you value when I have given my property for joint development? Because if you see in the Bangalore or in other cities, most of the cases, the real estate will be given for joint development only. The land is owner is somebody and developer is somebody. Like how you value those properties?
Good question. Is it from the developer's perspective or is it from the landowner's perspective?
It is a company's perspective. Like company has been appointed me as a valuer for
no.
real estate.
You are the valuer. You are valuing for the
company.
No. 1 second. Let me put the question again. Is the company a landowner or is the company the property developer who has taken the property on joint development?
The company is the property developer. Landowner is a different person.
Perfect. So I in fact, what I'll do is I have one case study also on this. In fact, luckily I have a case study on a real estate development using a joint development. Why don't we, typically you follow a DCF method in this case. Why don't we see it in our subsequent slide? And definitely you please point out if you want to add more questions while I'm explaining that. And if I skip out also, you please point me out on at that point in time.
Sure.
Yeah. Okay. Let us quickly go ahead. Let me keep a tab on the time also. Yeah. So let us quickly go ahead on understanding what is a cap rate. Generally, a cap rate is a cap rate in, again, like NOI, cap rate is also an equally important term which will help us carry out valuation using a rent capitalization method. Here the cap rate is calculated by dividing net operating income by the current market value of the property. But little unlikely that you'll get to know the current market value of the property, because using a cap rate itself, you are trying to find out the current market value of the property. So how do we calculate a cap rate? So there are a few methods available that you can do, but the popular ones are the built-up method and market extraction method. And also, see, not everybody does like discount rate, right? You might have a method to calculate, but typically, you know that if it is a equity return that I'm looking at, something with 1 beta with no with risk equal beta is 1, and debt equity ratio similar to what it is prevailing in the market, then your returns would be 15-16%, and higher the risk, higher the discount rate. Similarly, cap rate also can be based on thumb rule, or there are mathematical models to calculate it, and the valuer will have his own judgment. But let us focus on two methods. One is built-up method, one is market extraction method. I simply told you that capitalization rate is nothing but NOI divided by the current market value of the property. But right now you are valuing the current property, so you don't even know what is the current value of the property. Then how do you calculate a cap rate? So I'm just switching it to Excel. Uttam, please let me know in case you guys are not able to see this. 1 second. Can you see this screen, Excel screen, everybody?
Yes,
Yes, we
Uttam,
can see. Yes, sir. Yes, sir.
Okay. Yeah. Okay. So a built-up method to calculate a cap rate goes like this. Find out what is the risk-free rate prevailing in the country. In India, right now, the 10-year, 20-year bond are may not be accurate, but close to 5.9 or 6%. These bonds are very liquid, can be easily exchanged, but real estate is not as freely traded or as liquid as a bond. So to that extent, you should assign a liquidity premium for considering the illiquid nature of the real estate. Then, depending on the asset class, the real estate asset class, you can charge one more risk premium. Let's say a leased asset will not completely leased asset, and that asset is having a current market rent itself, not that it is traded at a very low market rent. Then it may or may not have risk premium. On the other hand, property which is not completely leased out, not as popular as property which is in the CBD suburb. Let's say let's compare to property in Bangalore versus Hyderabad. Bangalore properties will have better valuations, and the cap rate for Bangalore property is typically lower. And this point can be debated and all that, but in reality, that's how it is. Again, a warehouse versus a commercial asset can have a different risk premium. Again, as and when you get involved in more and more valuation assignment, you'll be able to understand this. But what you simply do is add all these three to get a cap rate. That's the cap rate. Now, how did I find? Now, this is one method where I found out the cap rate. Now, I'll use this cap rate to work out the valuation of a property in one of the methods called rent capitalization method. So let's do that at the subsequent stage. But time being, using a built-up method, we have calculated the capitalization rate. Another method is I want to calculate the cap rate for that I need to apply to my property. How do I do it? I'll look at the net operating income as well as the market value of other properties. So let's say there is a comparable property, a building or several buildings. One building, I'm giving you an example here, but there could be several buildings, and the net operating income of that commercial property is 87,500 for the year, whereas the sale price of that commercial property, or not just the expected sale price, actually it got sold out. Let's say in our example, instead of this example, we could, if we have market intelligence, we should be able to know what is the NOI of prestige assets, and what is the price that Blackstone has paid to prestige assets. I know that it has traded at around 8.4, 8.5%. let us, in our example, the rental is not the rental, the net operating income of the property is 87,500 and it got sold at 10 lakh. Then simply calculating 87,500 divided by 10 lakhs, 8.75 is the cap rate of a building which is next to my building, and I can use this cap rate to calculate the valuation of my building. I hope this is good enough. Let me go back to the presentation. 1 second. Okay. Now, what is the gross rent multiplier? See, like your multiples method, price to sales ratio, etc. Similarly, in real estate, you can have, again, not very popularly used. A gross rent multiplier is not a very popular. Something which is very commonly used is NOI and the cap rate, but let us dwell upon other terms as well. Gross rent multiplier. Gross rent multiplier is nothing but it is very similar to cap rate. It is an inverse of cap rate. 1 by cap rate is also, we saw a cap rate as 8.5 or 8.33. 8.33 cap rate translates into 12 times of a net operating income. 1 divided by cap rate will give you 12, which is a 12 multiple of the NOI. On the other hand, gross rent multiplier is also a multiple which is derived by dividing sales price by the gross rent that it can generate. Here, only difference between the 1 by cap rate is that in the cap rate you factor NOI after considering the outgoings, whereas in the gross rent you do not consider any of the outgoing. As simple as that, it can be looked at similar to cap rate. So let's not spend more time. And generally, you don't make use of gross rent multiplier. It is just a thumb rule calculation that you may end up doing. Price per square feet. See, when you buy a residential house, you work out a price that, okay, the house is 1,000 square feet. I am paying around 60 lakhs, a couple of lakhs are for car parking and other benefits, the common area, what do you call, the clubhouse, etc. You're paid, and you're paid 55 lakhs for the property, which is 1,000 square feet. So you end up working backward and find out what is the per square feet price. And in this case, it translates into 5,500. Likewise, in a commercial asset, when you're buying or selling, per square feet rate is relevant to work out based on what is the total property value divided by the leasable square feet or the sellable sellable area, and you work out the per square feet. Similarly, per square feet is also relevant from a tenant's perspective when he's calculating rent per square feet per month. What is the floor area ratio or a floor space index? Some people call FAR, some people call FSI. It is more or less the same thing. It is in fact the same thing. It is expressed, one is expressed in percentage, one is expressed in multiple. I can give example of Bangalore. Bangalore, where it also see a floor area, a floor area ratio or a floor space index. How is it calculated? It is the total area in each of the floors, or the gross floor area, divided by the area of the plot. Let's say you have a 5 lakh square feet constructed over a 1 lakh or a 2 lakh square feet plot. 5 lakh divided by 2 lakh square feet, it's 2.5. 2.5 is your floor area ratio or a floor space index. Higher the floor area ratio or a floor space index, definitely a developer will be able to construct more space, and higher would be the value of the property. This has a relevance before you construct the property. So every floor area ratio depends on the zoning regulations of a particular city, and within that city of a particular location. Let's say in Bangalore, there is an area which has a wide road. Government would be willing, the local body would allow you to construct a 3.2 FSI. Let's say it's a 1 lakh square feet plot, they'll allow you to construct 3 lakh 25 square feet. On the other hand, if it's a narrow space, let's say some lane within Jayanagar or JP Nagar, very congested road. There the local bodies won't allow you to construct more than 2 times or 2.5 times of the plot area. So a plot with a higher FSI will command a higher valuation as against a plot with a lower FSI. Having said that, in Bangalore, a typical wide road will have a FSI of 3.25 lakhs, but as I told, a smaller area can have 2 or 2.5. The floor area, on one hand, how much you can construct depends upon the FSI or FAR, but also it depends on what is the height restriction that you have. So take example of Domlur. I can talk about that because I was working in one of the real estate organization, and there was a property, and earlier we had the airport there. That property had a 3.25 FSI, which was permissible, but it had a height restriction because there was an airport there. So though a particular location might have a good FAR, but because of a height restriction, you will not be able to consume that FAR. Let me give example of Hyderabad. There is no concept of FAR only in Hyderabad. Hyderabad, like I said, real estate. What is real estate? Land below the earth, on the earth, and above the earth, right? So there is no restriction of FAR. You can construct a 10 FSI also. You can construct huge skyscrapers. No restriction. Obviously, height restriction. I mean, basically there is no FSI, but if you are closer to the airport, there would be height restriction. So and you don't even have to pay extra to acquire that FAR, because right now there are no restrictions. However, higher you go, higher becomes the construction cost, because the building has to be equally strong, and then typically the developer starts looking at the cost involved also versus what he's going to get the lease rent, and then he may avoid constructing a big skyscraper. But there is no such restriction in Hyderabad, apart from the height restriction if it is closer to the airport. What is the built-up area? If you see the last 2 lines, it is addition of your carpet area, then the space consumed by external and internal walls, as well as the parking areas, the utility ducts, interior parts, etc. So to that extent, of built-up area should be higher than a floor space ratio, FSI or FAR. Though it is higher, but what is looked into is the leasable or the sellable area, and for the leasable sellable area to derive, you don't consider BUA, but you consider the FSI. Let us go to one more important term, highest and best use. I'll give you an example. I believe most of you are from Bangalore, so I can give you that example. Many of you, sorry, there's a question from somebody. Uttam, you have a question or? Sorry, okay, I'm so sorry. Let us take example of, I'm sure everybody is familiar with the Lee Meridian Hotel. If not, let me tell you that a prime locality opposite Racecourse Road, it is the CBD of Bangalore, and most of the properties there have a very high value. And one of the real estate developer has acquired a Lee Meridian Hotel for almost 450 crore. There was a hotel there which was generating only 10-12 crore as EBITDA. For a 10-12 crore EBITDA, how much can you give? 15 times, 20 times, which will translate into 200 or 250 crore. However, the developer was willing to pay 450 crore. He paid that and has acquired the property. Now, what could be the reason? When you do a valuation of a real estate, it is not just what is the current use of the property, but also what is the best alternative use, what generates the highest value. So highest and the best use of that real estate needs to be factored. The real estate developer believed that I can rather demolish this hotel, construct a high-end premium branded residence. If you go a little further, there is in the Makery circle, Embassy one is there, and the per square feet price there in Bangalore. See, those who are from Mumbai and Delhi, they must be not thrilled by that price because the prices there per square feet are anyway 50,000, 60,000. I've even heard up to 80, 90,000 per square feet. But in Bangalore, you and me must be comfortable to hear 7,000 to 10,000. However, that particular location, the price per square feet is around 30,000 per square feet, which is very high for Bangalore standards. And the developer has that kind of mentality that he wants to build a premium residential development there, and he believes that if a 2-acre land, I can construct some 6-7 lakhs, even a 20,000 rupees per square feet will generate 1,000 crore of revenue. Obviously, there will be costs that you need to factor. We'll see some examples. Or if you do a prime.
Hanuman, sorry to disturb you. See,
Yeah.
the example which you have given, Lee Meridian, like the investor is looking for like 450 crores he want to invest, but as a valuer, I can give only up to 150 crores or 130 crores because based on revenue or market value per acre or whatever it is. I will give only 150 crores only, correct? I need not to give 450 crores. That is up to the investor.
No. You see. You are right to say that you would do the valuation. What is the right valuation? You should be doing the right valuation. I'm not going to say that because the investor has paid 450, I'll value it 450. I'm not saying to do that. But when you are valuing it, let me add, then I'll go back to your question. But what I'm trying to say here, when you are valuing that property, don't look at it only as a hotel. That hotel can be demolished and a skyscraper can be built. Just because there is a hotel, I'm only going to value it as a hotel, then I think I'm making an error. And that's why this particular term is very important. And most of the real estate appraiser will look into it. Let's say there is a vacant land, prime land, okay? You own that land and you are worried that somebody can acquire that land. So what you do, you only to ensure that no other person goes and encroaches that land. What you do is you build one small room, okay, and you let it out to a laundry wala or iron wala who will sit there, and his family also stays there. And you must have seen this several places where you'll have some small places in a big land parcel. That guy gets to stay free or at a very nominal rent. Now, if you are going to value that basis that, then it is wrong. And if you accept this point of mine, that yes, the value of the land is not just based on the rent that this small house is paying to the landlord, then similarly, the value of the property that I just gave an example cannot be just dependent on the hotel that is running there, but upon what is the best possible use of that land if I don't use it as a hotel. So I let me not get into the fact whether the 450 is the right price or 150 is the right price. But what is the right price when you are trying to derive that? You please factor other alternative uses that anyone in the market is willing to do it. I'm not saying that one particular person is willing to do, don't do that. But in market, if other players are also willing to do that, if you see next to Lee Meridian Hotel, there is, I think there is a Prestige apartment, very rundown apartment. Today, the per square feet price there is 20,000. Next to that, Nitesh, I mean, let's not talk about Nitesh. He's completely gone. But the rundown apartment today of Prestige is today, if you go and see what do you call Magic Breaks or similar other website, you'll see that people are willing to sell a 3,000 square feet apartment for 8-9 crore. You derive the per square feet price, and it's a rundown. If somebody comes up with a really new development, people will be willing to pay. Now, will you not consider the price of Prestige Let me not you should not consider what a real estate developer is willing to pay for it, but you know the market condition. Will you not consider the price at which Prestige is selling the existing apartments are getting sold? Will you not consider that?
Yeah,
So
we
one
have to
question
consider.
on that Prestige, sir.
Sorry.
So, bro, one question on Prestige. That Prestige upshot which you're talking of, I think,
Yes,
let's assume that is residential construction. And
correct.
next to that, Nitish is also there, which previously was Shetron. So therefore, it may be commercial. Now,
Correct.
in the case of Le Meridien, will you apply
Huh.
residential or commercial? Because of zoning, I'm not sure. What would be the
No, see, what you will do is, I look into, you can get, see, a hotel, you can always go and seek permission for residential. You can always go and seek permission for commercial building. I will try and find out which will generate higher returns to the developer. When I am doing, and when I am a valuer, I will not even look at what that, see, the intention of the, I have worked in that organization. So the intention when they brought was to develop a premium residential development. But then when they realized that Embassy One is not getting sold the way they had thought of, and then when they saw that Prestige came up opposite to that, I think behind the race course there is a huge commercial development that Prestige came, and the rent there is around 150 160 rupees. And the moment it was launched, everything got leased out. There is a Deloitte building also, 3-4 floors Deloitte building, and then there are other, if anybody has visited, it's a fantastic building, and it commands a rental of 150 160 rupees per square feet. As a real estate valuer, I will not only look at Prestige upshot, I'll also look at that Prestige commercial building. I will make a judgment. It is my judgment, not what the real estate developer says that do it. I mean, everybody does real estate valuation, and I'm sure to some extent you listen to the guy who has given you the assignment as to what he wants to do, but you will use your judgment and find out what is the best use there. If residential development, he says that I want to do residential development, and if I believe that the valuation of that property is more can be derived using a commercial property, I'll go with that. So I will try to find out which is going to generate the highest value to me, highest value to any market participant for that particular land. Sorry.
Hanuman, one more thing. See, highest and best use means then the perspective of each value is different. See, I have a 20.
No. Don't see that. Then the valuer is making a mistake. Don't look at what is the perspective of the valuer. The valuer has to get into the mindset of the market participant and decide the highest and best use. If he cannot see, then it's an error made by a valuer. It's a judgmental thing. I agree. You might think in a different way. Somebody else might think in a different way. But you have to put yourself in the shoes of the market participant and think that what a real estate developer would be willing to do here. And you should think from various real estate developers' perspective and find out what most of the real estate developer would have done. Maybe Embassy could make a mistake. There could be other real estate developers who would make a more sensible decision and do that. Then you follow that. Or maybe Embassy is also thinking like any other real estate. You follow that. You feel that there should be residential, whereas the market participants are thinking that there should be commercial development. Then you are making an error. So though the judgment has to be made by the real estate valuer, but the real estate valuer has to think from the perspective of what any other real estate developer would have done. Now, did I answer your question?
Okay, that since Hanuman, you were talking about Embassy. See, when I'm doing the ST mall valuation, I cannot take how Embassy is using. I cannot apply same to the ST mall valuation. Correct? Both are at the same place. See, like
Agree.
I can't think that ST mall will think like Embassy and they do like Embassy one more big project. I cannot use the highest best use. Then my valuation will go like anything. If I use
no,
like,
you have to see. If ST Mall is going to continue as ST Mall, let's say there is a ST Mall, as you said, and enough money has been spent on it. Now demolishing it and doing something else makes no sense. If you demolish that and reconstruct, you'll also have to incur the cost, right? So you, on one hand, you might consider it, but let's say there are certain FSI. I'm going to give you a similar example. I can maybe I'll. Okay, let's talk about this. In case of Esteem Mall, if the demolition cost is very high, as you rightly said, that most of the developers will not be willing to do it, then you stick to the valuation as a retail mall only. However, if that Esteem Mall is not making the full utilization of the area, and there is much more better usage, just because embassy thinks that they can do a skyscraper, don't do that. What a typical real estate developer would think about. You please factor that. There would be 10 there would be 10 real estate developers. Of that, one guy owns the Prestige Mall, the Elements Mall, and he doesn't he doesn't want to do anything. That's a different thing. But if 9 such people are willing to kind of demolish it and construct it, you can always value it. So there is no restriction on you not to. You have to see from the market participants rather than only from one real estate developer. Is the point that I'm making. You are free to make your judgment.
Yeah, even the same thing will applicable for Lee Meridian also, because it is a 5-star hotel. Okay, even demolition also is very difficult. If you see like Extreme Mall.
Okay, now that we are getting into this, let me go to Excel and I'll show you something if you guys are okay.
Yes, please.
Yeah, 1 second. Let me go here. Can you see the screen? Can you see the screen, guys?
Yes.
Excel.
Yeah.
Blanks. Yeah. So I know that the EBITDA or the NOI of that hotel was 12 crore. Typically, 7.5-8% is the maximum cap rate, at least prevailing in Bangalore. 7.5% is a cap rate that maximum in current times you can go. Okay. 12 divided by this 7.5%. What is the value that you're getting for a hotel? 160 crore. This is a rent, guys. I have not touched upon rent capitalization method, but rent capitalization method says that take the NOI of a property divided by the cap rate, and that's where you get the valuation. This is 160 crore. Am I clear with this?
Yes.
Now there is something called, now there is a Lee Meridian hotel, and I believe that, or not I, what a valuer believes that there are real estate players who can do a high-rise building there. That building, the Lee Meridian hotel is 2.2 acres. The FSI there, permissible FSI is 3.25. The TDR there can be used to acquire higher FSI, premium FSI for 75 to 100 crore. Let me say 100 crore to be on a conservative basis. You can acquire 60% maximum FAR more. So what is the FAR that you can, instead of 3.25, you can consume 5.2 FAR. Now 2.2 acres into 43,560 square feet into 5.2, you can develop 4,98,000 square feet. I'm not even going anywhere else. Let us only stick to Prestige Upshot. Not even anywhere. If I do a better development, the prices will be higher. Let's stick to 20,000, which you and me agree, because that is getting sold. 20,000 rupees into this square feet divided by 10⁻⁷, you generate close to 996 crore. Construction cost. I'm from the real estate space. 5,000 rupees per. The location is premium, not the construction. They don't put gold here. They will still construct it the way they construct any other development. Probably outer look will be a little different, but the inner walls and this will be more or less similar. Generally, you can do a construction at 2,200 rupees. Here they will end up spending 5,000. Why 5,000? Let's say 6,000. 6,000 into this divided by 10 raised to 7. Plus, I said 100 crore for the premium FSI. You generate 996 minus 298 minus 100. But this will generate, let's say, after 2 years or 3 years. I'll discount this by appropriate discount rate. I'll take as high as 20% divided by 3 years. I'm still getting a 345 crore valuation. I'm being very conservative. What embassy was believing it will be able to sell it for 25,000. Leave it. I'm only assuming 20,000. Now, if at a conservative basis, will you not value at least 345 crore? Or will you still value it at 160 crore? I'm not even going, the embassy paid 440 crore for it. When I got the valuation done from JLL, JLL was willing to give a valuation of 340 here. Will you still value it at 160? Or are you getting convinced at 345 at least? Maybe the discounting factor could be higher. Why 20? It could be 30, which is unheard of, but 30. Still you are 272. Why will you value it at 160? I mean, I don't want to debate on the valuation that it should command, but do you at least agree on the concept that I will give importance to the highest and best use?
Yeah, we can give the highest and best use, but it may not be materialized also. See, if I give like 300 crores, 400 crores, if the investor will not come, it will not be materialized. And what is the
No. Don't think from who will come here. You
Correct.
think from a market.
1 minute. See, what is the name I can give? Can I give for that 300 crores, 400 crores, highest and best use fair value method? I can give the name.
No. Name of the method is DCF method. You'll follow a DCF method. But one of your assumption is that I have considered the highest and best use of that land. Methodology is DCF. Methodology is DCF. But this is one of the factor that you have considered. Highest and best is not a method; it's a factor or an assumption that you are making.
At the end of the day, I have to give 2 values or 3 values. It is like fair value, liquidation value. Okay, can I consider this highest and best use as a fair value value?
Definitely, it's a fair value. It is not a liquidation value. Liquidation value would be definitely lower.
Yes. Then what about the market rate prevailing in that area? What is that value? I can give the name for that.
No, this is a fair value. No? Now, if it's a distressed sale and you want to do a quick and see what I want to do quickly, what I'll do is today it's a land. There is another method called land and building valuation. What I'll do is, let's say a nearby land got sold for 110 or 120 crore per acre. 120, 130 crore per acre. This is 2.2 acres. I simply multiply that and say that this is the land value. And the building there is useless or it is depreciated value. So you quickly calculate the building value and depreciate it for 20, 30 years. You may get a nominal value or sell it as a scrap at the scrap value. That method also you can follow. Point that I'm making is what method you are using is not relevant. I'm only trying to, we are getting into 2 specific things, but what point I'm trying to make is that when you value asset, please don't only consider what it is used. You also factor, see one particular developer, like you rightly pointed out, that don't look at what embassy wants to do. Very true. Don't look at what embassy wants to do. Try to look at what any other real estate developer would have done here. What a sensible, normal real estate developer would have thought about it. Factor that, and among that, find each real estate developer could have had 2 uses. It could be commercial or it could be residential. Use the one which generates highest and best value to that real estate developer and value the property. Is the point that I'm making.
Okay.
Yeah. I'm sure there is a lot of debate. 2 hours are not sufficient. In fact, we can only debate on this point. So let us go ahead, and we can always be in touch and discuss.
I have a question on the previous slide, the FSI.
1 second. Yeah, tell me.
Yeah. So the FSI, does it include the basement area?
No, that will be part of BUA, built up area, not a part of FSI.
Is there any regulation on how much the basement area can be, how many levels and so on?
I don't think so. That and probably I'll accept it that I'm not very sure about the regulations and all that. I'm not an expert there.
Okay, fine.
There is, but the floor, the basement and all is part of BUA rather than the floor area ratio. Some location they'll even factor BUA as part of FSI. I mean, BUA is a little bigger than FAR. And typically what developers do is they only factor the sellable or leasable area when they are doing. In fact, the actual built up area could be higher than the FSI. In some locations that could be restricted, but in Bangalore, what I know is what you only look at is the sellable area, not the UA.
Okay, and second question, because you mentioned, the FSI is there, but the height of the building is regulated and so on.
So,
is there any restriction on the height of the ceiling? And does it differ between residential flats and commercial property?
I don't think so. There is any such regulation. Again, let me tell you, I'm a financial person. I'm not a very good regulatory person, but as a valuer also, I should be knowing all this. What I believe is it is more done from practical parlance rather than regulatory thing. Obviously,
yeah. So I heard for residential, because we live in flats and all that. So I heard it is 10.5 feet. I don't know whether 10.5 or 11 feet. Ceiling cannot be less than that. But I think for commercial it may be less, at least.
Commercial.
I'm not sure.
I don't think so. They'll do it less. It is, in fact, it will be more. Because when you're talking about, when I say commercial, I'm not talking about high street. I'm talking about commercial office spaces and all. And there are a lot of people who will be using, let's say, an IT company, a lot of employees there. So they would like to have a higher floor, higher size of the floor rather than lesser than residential. But nobody gets into. Obviously, I have not got into the regulatory aspect of it. More than regulatory, the developer would not like to construct a smaller height. If he does that, then his building will never get leased out, or it will never get.
No. So there are builders who actually advertise that our ceiling is 11 or 11.5 foot. Compared to
that is a selling point.
So
that's
people
a selling point.
do economize there also, whatever they
in fact, people will go and follow a standard height. Okay, but there are villas and all, or there are some premium development who would say that I have done a higher so to that extent he will charge you more also, because he has if there is a height restriction, even if there is no height restriction, just putting a floor is not important. Even if that floor is higher than a typical floor, the cost of the developer increases. So, and accordingly, he'll charge it slightly higher also. So sorry, the point that you are making is whether is it governed regulatory wise. There, I'm not an expert there, but I know more so that if it is not done as per the typical standards, then the property either will not get sold or it will not come under good value. And that's why, like you yourself proved it, that there are people who show that we have a higher floor rise, so my building is better than the other, so definitely it will command higher value. Should we go ahead?
Yes, please.
Yeah. 1 second, let me start the. Sorry, I think we are 9:15 and I have to cover a lot. Let me go quickly to the next. I'll launch the poll. Let us do it quickly. I'm launching stop share result. Quick. Can you? I think somebody is not. Can you please put yourself on mute, Mr. Venkat and others? Yeah. I just confused you guys, but as I told, cap rate is dependent on NOI and current market value. But I just used different way it can be presented. But the correct one is NOI by current market value. Okay, let's go back. Can you see the screen, guys? I think so. Let me go ahead. Sorry, one more. This is important. I try to answer this, please. Let's see how many of you answer this correctly. I try to play around with some words. Please answer it carefully. This is the most important element in valuing a commercial property. I just played around with keywords. Look at NOI as EBITDA. Yeah, most of you have answered correctly. D is the right answer. Okay, let us quickly, I would like to make the best use of the available time. Let us quickly understand the factors of real estate. When you value factors or assumptions that you consider while valuing a real estate. Location, we just now saw real estate located in the CBD will command a higher value as compared to a real estate located in the suburbs. Best example was that Prestige Upshot versus even a Prestige equally, or Prestige Upshot is a kind of rundown building. If there is a very premium constructed building in a very in a suburb location, also the Prestige Upshot will command higher value. So location is important. People like to stay in prime localities. Usable space. I can give example of I was involved in one of the mergers that Embassy was doing in India Bulls, and there was one particular residential development in Mumbai. And we were trying to see the sales MIS, and what we figured out that one particular development was in a prime location, but last 2 years it was not getting sold. And then we realized that the price that we were commanding was more or less same as compared to any other commercial, any other residential development which is in and around the vicinity. The problem with that was it was having a huge 700 square feet of terrace. Whereas Mumbai guys would prefer 2 additional rooms instead of that terrace. Though balconies are important, but they would not end up paying for a 700 square feet of balcony. Rather, they would like to have a 100 square feet or maybe lesser than that. So the usable space available in a residential premise or any other property also matters. Age, Prestige Upshot versus, let's say, had a premium development done already next to Prestige Upshot, then more than Prestige Upshot, the recent premium development would and the recent development will have a higher value as compared to Prestige Upshot, because Prestige Upshot is a rundown building. Condition of the structure, sometimes more than a property could be old, but it was maintained properly, then that property will have a higher value. So the condition of the structure also equally is important. Upgrades and updates. Let's say within a premium development, a commercial development, there are two houses. One of them has updated it with and renovated the house with all the premium quality, renovations, best quality kitchen, best quality wardrobes, etc. That will have a higher value as compared to a one which has a basic renovation. Again, the outer appearance of the property also matters. Let's say there are two villas, and if that one villa has a very nice garden, proper sprucing of the garden has been done, and it looks really beautiful, it may end up commanding 15-20% more than the villa which doesn't have. So outer appearance as well as the upgrades and renovations are important. Like any other property, demand and supply in a particular locality matters. Higher the demand, lesser the supply will have a will make the property premium. On the other hand, more supply, less demand will pull down the valuation. Again, we were talking about the FSI, etc. Right? Similarly, the regulations that are prevailing in the locality matters. If a particular 2-acre land, let's say, if you see this lake terrace, behind that there's some 15 acres land that embassy had acquired, but the FSI available there was only 2.25. because the road was not that wide enough. On the other hand, maybe next to it, where the FSI is 3.25, if there is a land available, that will command a higher valuation because it has proper building regulations, etc. Sorry, you get a better FSI there. And let's say there's a building which was supposed to consume only 3.25 FSI, and it has consumed more than that, then because it has consumed more FSI without having the permission for it, people will not give value to that additional development that has been done on that. Lastly, interest rates also play an important factor in valuing a property. If there are huge real interest rate, when you are doing DCF itself, you'll realize that it will pull down the value. But the real estate, but if you look at it from the developer's perspective, he would like to charge it the price of that residential premises. He would like to charge it more. However, it cannot be beyond what is market prevalent. Otherwise, he'll not be able to sell. So, higher interest rate for the developer increases his cost, and he would like to charge more, but that doesn't mean that it should definitely get sold, because market will play the role, and if something else is available cheaper, his property will not get sold or will get sold very slowly. Renovation potential of the property. Let's say a property allows the buyer to do more renovations, or he can kind of improve that property. That property will command a higher value. Economic conditions of an area, let's say Bangalore versus Mumbai versus Hyderabad. Bangalore commands higher valuation as compared to Hyderabad. The rentals in the CBD are close to 150 because there are better economic conditions, better opportunities, financial opportunities available in Bangalore as compared to Hyderabad. On the other hand, in the CBD of Mumbai, you'll see the rentals going as high as 350 rupees also. Today, I won't say CBD only. Earlier, Nariman Point used to command rentals of 340, 350 rupees. Now it has gone down to 220 rupees per square feet. On the other hand, BKC is today commanding, but these kind of rentals are not heard quite common in Bangalore. And when you go to Hyderabad, today the prime location is Gachibowli, and there the rentals are in the range of 50-55. The demand for area, ignore COVID, but the demand for area, leasable area is much higher in Bangalore as compared to Hyderabad, and it is much more higher in Mumbai. So the economic condition of the area where the property is located also matters. You need to factor that when you value the property. You cannot value a property in Bangalore as same as the one in Mumbai. Alternative and best use, I gave an example of Lee Meridian. We can keep debating on that. Scarcity, if commercial properties are not infinite, right? There are limited commercial properties available. So lesser the commercial property available in a particular locality, higher will be the value of that. If more assets are available, like in Hyderabad today, the situation is worse than Bangalore. There are so many commercial development available and very limited people to take on. The properties are rather abundant, so the valuation is lower. Transferability. If a particular property is freely transferable, then as I was explaining you the capitalization rate, if a property is freely transferable, then the premium applied on the capitalization rate should be lower. So your property, I think there is somebody who's Mr. Harish Patel. I think you should put yourself on mute. Thank you. So in case there is restriction on transferring the real estate, then the value of that real estate would be lesser. I can give you example again from Bangalore parlance. How many of you are aware of Diamond City? It's in Domlur. The price of the flats there is, had there been any other property, the price, similar property, the price of the apartments there would have been higher. However, the price of the apartments there are lower.
Monetize all this land they have.
Sorry?
Their budget deficit will be over.
I think somebody has put yourself on. Can you please put yourself on mute? I don't know who's that. Yeah. Transferability. Transferability. I can give you an example of Diamond District. Here, buying a property in Diamond District is little not that easy. Selling it is also not that easy. Reason is the houses are not registered in your names. In fact, the shares or kind of units are there, which are given. It's kind of a trust or a company where you are getting units instead of the residential house. Now, taking a home loan against that becomes difficult. So, though the location is prime, but because of this particular issue, there are either restriction on transferability or a restriction on raising a housing loan. As a result of which the value of the property, the transferability is less, it is not freely transferable. So accordingly, the value of that particular development, residential development, will have lower value as compared to any other value nearby. Okay, let us if I'm good enough here, we can go ahead with the methods. If there are any questions, I'm happy to answer. But let us take the methods, and then I'll show you some case studies also. I have half an hour, probably I'll be able to show you all those. Can we go ahead? Yeah.
Let's move forward. Mr. Joshi, I have got an answer.
Sorry. Yeah, I'll take one question and then I'll go ahead. I think somebody was asking the question. I'll take that question and then I can go ahead, please.
Yes, my question is the way you are.
I couldn't hear you, sir. Uttam, could you hear him?
Sir, can you please repeat the question?
Yes, can you hear me now?
Yes, sir.
Oh, can you hear me?
Yeah, okay. I can hear you.
My question is related to this Le Méridien case which you are explaining. Insolvency cases, when the company goes into insolvency and after that into liquidation, at that point in time, even if you mention the fair market value as a value which you are explaining here, the highest one, the best alternative use method, would it be permitted? I mean, once you go for that, on the other side, there is a liquidation value. When the buyer compares it, I'm coming to that. My question is slightly different. One is this best use method value you gave, which you would call it as fair value. Second is you will say it's a liquidation value. Buyer will assess it on the basis of the lowest one, and based on that, when it would not be sold, then again the second round would go, valuation would go down further. They were this committee of creditors who will revise the price, and then third round would go on, and ultimately it will go on like this. At some point in time, this IBBI would catch hold of you, being a valuation regulator, that what is this. So then as a valuer, where do I stand? If I start if I try to justify myself that look, I did it on the basis of this, I mean, would it not be a practical thing that I should go on the basis of the use which is there already at that point in time? Hotel selling as a hotel.
Okay. Hmm. So, firstly, I'm not well versed with the IBBI regulations, but I can understand what you're trying to say. I want to give a highest and best use, but in a liquidation scenario, valuation is not coming down, the price is coming down. Valuation is the
Yes.
estimated market price. Now, when I'm doing that, now I should also factor liquidation scenario. In case of a liquidation scenario, I have to assume that this property needs to get sold in 1 or 2 months or 3 months time. When I'm assuming that this property needs to be get sold in 1 or 2 or 3 months time, then the marketability of the property will get reduced, and accordingly we'll have to factor that kind of a discount to the valuation. Now, whether that is 15, 20, that depends on the available time within which it can be sold. And I'll give a marketability. That doesn't mean that I'll follow another method. I'll still follow a highest and best use, but I'll also give a factor that I need to sell it quickly. And if I have to sell it quickly, I might have to offer it at a lower price. To that extent, I'll give a liquidation. To that extent, I'll give a discount towards that. Now, whether regulations will stop me from doing it and all that, I don't want to get into that. I'm not an expert in that area, but I completely understand where you're going from.
I am giving you a latest example.
Yeah.
I'm giving you a latest example. I mean, it was not practically a real estate case. In that case, the principal, I mean, I don't know whether you will understand that or not. This principal bench of NCLT, the valuation was, say, 100 crore. And when it went into liquidation, it came down to 20 crore. Now, the principal bench, the judge over there said to the chairmen of the bank who were the creditors in that project, that why don't you take action against the erring officials when the security value has gone down from that amount to this amount within a span of just 1 year. So what I'm trying to impress upon is that if you give this kind of valuation, so you are subjected to risk also as a valuer.
Yeah, you are definitely subjected to. Okay, sorry, Uttam, you're saying something. Please go ahead.
Yeah, Rajesh sir, just to basically add to
I was
this.
saying that as a
just to basically add to this, HABU, highest and best use, would not be a method, it would be an assumption. And as a valuer, when we are disclosing the assumptions on the basis of which the valuation has been done, then that is where I have fulfilled my obligation. Now, whether that assumption is subjective or not, whether it is possible or not, is for the circumstances to decide. Whenever we are putting the HABU, highest and best use assumption, it is best for us to put that value which is possible, highest and best use which is possible. We cannot, as you rightly said, we cannot pull out some number from thin air and say that this is the highest and best use value. So that which is possible and feasible best use of that asset is what we assume, and accordingly we can proceed. Yes, sir, Rajiv sir. Can we? If it is
endless topic,
too
yes,
time
you can carry
consuming,
on.
Yeah,
if it is too time consuming, we will take it offline. There are a lot of there will be a lot of Excel workings which is pending. Excel work which is pending. Since we are running a bit short of time, we'll just finish off the Excel workings and get back to this question.
Yeah, and I'll share my contact details. We can definitely discuss on this separately. Yeah,
Last one point. I think in IBC we cannot use highest and best use method. Okay, we have to use, as IBC guideline said, we have to use net.
This is what I was trying to say.
Net realizable value.
Okay. As I'll reiterate.
Exactly.
I'm reiterating. I am explaining you real.
Sure.
I'm not sticking to the
Oh, yes.
Lines.
Okay. No, it's not.
Explaining you realistic.
I mean,
methods. Sorry.
No issues.
There is some disturbance. Can people put yourself on mute so that I can go ahead, and I'll be happy to take more questions. Let me finish my presentation. Okay, thanks a lot. There are several methods, and like any other method, like any other asset valuation, there are three approaches: income, cost, and market. Within that, there could be several methods. Let me touch upon few methods which are falling part of these approaches. Rent capitalization method or income yield method. Firstly, where is this suitable? It is mostly suitable for a commercial asset, rent generating asset, and with long lease, and assuming that the leases are at market rent. What you do here is simply calculate the net operating income of that property of the subsequent year or the coming year and divide that by an appropriate capitalization rate. Whatever you get is the valuation of that property. We have already discussed what is the net operating income. Let me quickly, I'm very simple, I'll show you in Excel. If you see this screen,
we can't see your Excel, Mr. Hanuman. Mr. Joshi, your voice is also cracking.
Can you see the Excel?
No, we can't. Yeah, now we can see the Excel.
Yeah. So the discount rate, the weighted average capital rate, weighted average cost of capital is 12.5%. Growth rate is 4.5%. Sorry, why is this coming up? Okay. Cap rate, either you have derived it or let me not get into the calculation of cap rate, but assume that 8%. Now the rent per month right now is 50 rupees per square feet, and year on year it is growing by 4.5%. I quickly calculate the rentals. 50 rupees into 1 plus growth rate, and this would be the rental for the subsequent period. Year on year it is growing. The vacancy, the operational expenses are close to 5%, and this is the area. The gross monthly rent is nothing but per square feet into the area, and I drag it. What is the annual gross rent? It is nothing but monthly rent into 12. I drag it until the end. What are the expenses? It is here we have factored it as 5%. So I simply take that 5% and I factor the expenses. What I'm trying to derive, I'll just tell you what I'm trying to derive. I calculated the NOI, which is gross rent less expenses for each year. And in the 5th year, like your Gordon's model is there, what I do is I calculate the 6th year rental using the 5th year NOI. I say 1 plus growth rate divided by my KE minus G, which is nothing but 12.5 minus 4.5, and I get a valuation of 88,750. Then, like any other method, I've calculated the discounting factor, then multiplied it, and then I added. I added the cash flows each year. In the last year, it is that year's cash flow plus the terminal valuation, and then I've discounted then, and I'm simply summing this up to get the value. One way to calculate is this method. On the other hand, I told you something on net capitalization method. Right? This was a DCF that I followed. On the other hand, the NOI, if you see, what is the NOI for the next year, that is the first year, is nothing but this 5,700. Am I right to say that? And what is the cap rate? The cap rate is 8%. So what is the value of the building? This divided by the cap rate, which is same as the 71,250 that you calculated. The point that I'm trying to make it is deriving the similar value as a DCF. Point to be noted here is the cap rate, like in your Gordon's model, is nothing but the K minus G. If this cap rate is different from K minus G, obviously the value will be different, but it is assumed that a rent generating property will have a cap rate which is a difference of WACC minus the growth rate. But as a valuer, you can use a built-up method and work out the cap rate. If the rates are different, then obviously the value will be different. In this method, if we quickly look at what is the NOI of that property, is what we calculated. We applied the cap rate and we got the value of the building. Please note that we did not factor taxes or the depreciation here. This is the enterprise value of the asset, not of the company. And that's how you do real estate valuation. So you do not factor the taxes before you. So you're finding the value of the building before the taxes. So this is a rent capitalization method. Let me touch upon another method. And if you have any questions at the end, after I discuss all the methods, definitely raise them. I'm back to the PPT. I hope you guys can see this.
Yes, we can see the PPT.
Okay. The next method is term plus reversion method. It is very similar. I told you that the first method is suitable for commercial properties which have been leased, generally for commercial properties on a long lease. Now, let's say there is a situation where the properties have been leased out at a smaller term, or they have been leased out for a rental which is either higher than the market value or lower than the market value. If that is the situation, please remember that ultimately you'll catch up with the market. Once the existing tenancy gets over, it is most likely, it may not happen so, but it is most likely that the property will get leased out back to the normal market rentals. If it is leased out at a higher rental, it will go back to the it will go back to the normal rentals. If it is leased out at a lower rental, it will go back to the higher rentals. So in such scenario, what you do is you calculate the value of the property in two stages. First, derive the NOI for the period until which the tenancy exists. And beyond that, assume that you'll catch up with the market, calculate the NOI and carry out the discounted cash flow. Add the discounted cash flow from both the stages and work out the value of the property. If the property is leased out, great. If the property is half leased out and half vacant, then in case of the leased out, the way I to explain, you can work out. If it is vacant, what you can do is assume that that you'll have to do some marketing spend, etc., for the next 5-6 months or so, and then it will get leased out to the market rent. But if it's a COVID-like situation, assume a longer vacancy period and value it. But definitely it will not, you cannot assume that this building will remain vacant forever and has no value. It definitely has a value. It is not like your normal vacancy that 2 or 3% vacancy that any building will remain vacant when the term changes. It's not like that. If a building is more than 40, 50, 30% vacant, that you cannot assume that it will never have a value. It will still have a value, but it will have a value dependent on time period that you are willing to spend and the marketing that you are going to do. Let me quickly go to the Excel again. Can you see the Excel, guys?
Hope the Excel sheet will be shared with the participants.
I can share the Excel.
Yeah, just so that it will be convenient.
Yeah. I'll quickly run this. In fact, I'll definitely like to share this, so I'll do that. Not an issue. In this example, what I'm doing is the rental is 40 rupees, and let's say the first 2 years, the property is going to be leased out as per the tenancy agreement, which is a year-on-year growth of the base rate by 4.5%. So 40 into 1 plus 4.5%, which gives me 41. But subsequently, the market rate there prevailing is, let's say, 90 rupees. Now, what I do is this, I'll assume that from the third year, the property will get leased out at the market rent. So first 2 years, 40, 41, and from the third year, 90, 94, 98. Same 5%. I calculated the NOI for each of the years. I calculated the cap rate and applied it on the 5th year rental. And I calculated the discounted cash flow and worked out the value, which works out to this particular number. On the other hand, what I can do is I can simply go to the NOI of the third year. Is this the NOI? Yeah. I can calculate the value using the NOI and the cap rate. Sorry, this is the cap rate here. So NOI of the third year, cap rate, value of the building as on the second year, because if I use the third year NOI and apply the cap rate, I will get the value as at the end of the second year. What is the value at the end of the second year? You have to discount it to today's terms. So I'm going to use the second year discount rate, discounting factor. And then I'll also add the rentals for the 2 years at 40 rupees that I'm generating. I simply add these two, I get the same value as this 1,09,151 million rupees or 10,915 crore. Let me go back to my PPT.
Can you just show me the Excel sheet once again?
Yes, please. Yeah. Can you see it?
In this, if you add this last three of discounted cash flow, not 4 or 3, 7, 6, and 87, it will become to 101. So it is just a
which one?
presentation change.
Sorry, come again.
I am talking about if you add this your F, G, and H, F23, G, and H. If you add 3, it will become to 101.
Correct. So see, what I'm doing is instead of doing this entire exercise, I did it by one was the DCF.
Yes.
And one I did by using a capitalization rate is what I'm
Tom and reservation. Okay.
Yeah, you're right. It should derive the similar valuation because see, and that will hold true if your cap rate is a difference of the discount rate and the growth rate. The moment that changes, let's say here I change it to 7.5%, the numbers will go for a change. See, this 140 versus 115, it's not matching. So the cap rate, as long as is a difference of the WACC and the growth rate, this working will match. Otherwise, it will not. Okay, let me go ahead.
So the summary is correct that discount rate and growth rate, if the cap rate is difference between the two, the value will be same. Otherwise, it will have a difference.
Yes. Otherwise, it will have a difference. Definitely, it will have a difference. And see, nobody follows this mathematical formula.
Yes.
You'll build up the cap rate will generally be built up method, like I worked out, right? Depending on the
correct.
But theoretically, it should match like this. Theoretically.
Yes. Theoretically.
Okay.
Thank you. Thank you.
No worries. Okay. Let me go back to the slide more, please. Yeah, I believe you can see the screen. Let's go quickly understand DCF method. See, rather than explaining here on the screen, I straight away go back to Excel. I'm so sorry. I'll go back to Excel. Can you see the Excel?
Yeah.
Can everyone? Yeah. Okay. See, no need to spend time on DCF. On the theoretical aspect, everybody is aware it's a discounted cash flow method where you calculate the discount rate and calculate the cash flows for the subsequent period and work out the valuation. What we saw, the rent cap and term reversion method also, I also worked out the DCF. So you already saw DCF twice. Now somebody had asked me on the JDA bit. I would like to quickly, run through this model without going cell by cell, because it's a huge model. I'll be sharing this template, so it will be useful for you guys. Here, the land, and it's a JDA situation. The land is. I want to tell you what are the assumptions now. Let us not get into calculations here, because it will never be able to complete this model, because this itself, for me, it took me at least 3-4 hours to build this model. Here it is a 32 acres land parcel. You are doing a villa development. The permissible FAR is only 2 acres. So the total area that can be built here would be 8,48,372. If you see the right hand side of the screen, the JDA sharing ratio, the developer will keep 69% and he'll develop 31% and give it to the landowner. So the developer, end of the day, will end up getting only 5,85,376. Depending on the size of the units, I worked out who gets how much units. So that's a calculation. I'm going to launch the sales only from, because I have several JDA projects. So I'm going to launch it only on 31st July 23. I believe that the marketing expenses that I need to incur would be close to 3%. What are the costs that I need to incur? I need to incur close to, this actually speaking, I need to pay a refundable deposit of 7 crore to the landowner. I need to pay registration charges of 1.4 crore, brokerage of 1 crore, etc. That I converted into per square feet of the total built up area, not the area of the developer alone. Then the construction cost, the site overheads, I need to incur, the consultants that I need to pay, the marketing expenditure, the consultant, the marketing fees, I'll have to advertise the project. Then I also collect certain pass-through expenses, pass-through money, which I have to collect and give to, I have to spend on the market, on the maintenance, as well as once the building is ready, I have to hand over the corpus to the association. Bestcom, I collect 200-250 rupees per square feet from the buyers, but I actually incur only 100 rupees per square feet. Selling cost is what generally a real estate developer will make use of external agencies, and which is most of the cases. Your in-house sales team will only do the talking stuff, but the real sales are done by the channel partners. So every time you sell, you end up paying 3% to the channel partners. In my analysis, I assume that only 1/3 will be sold through channel partners. So I charge 1% for all of the assets, which is effectively 3%. But in real situation, you may end up 60-70% getting sold through channel partners. So then accordingly, I should change the percentage. On the cost, I'll have GST, various elements. You guys are expert chartered accountants, so you are much aware of the real estate. The construction cost today on the residential development, there is GST on the construction cost, whereas when you sell, you're not allowed to set off. You'll have to collect 5% on your sale price and give it to the government. So on construction cost also you do, and on the sales price also you end up paying GST. And this is the total construction cost, 3,820 rupees. This is for total built up area. But right now, if you really see this square feet area, if I divide by the JDA share, which is close to 69%, my real construction cost per square feet of my sellable area works out to 5,535 rupees. What I've done is then I also factored what should be the selling price. So my base selling price, when I start, I'm going to sell it at 6,000. I'm additionally going to charge 188 rupees for clubhouse. I already consider this is going to go to my pocket. I'm going to charge PLC. This will come to me. Floor rise also I'm going to charge separately. Car parking I'm going to charge. City infra charges I'm going to charge. Again, this is my income. Already I have factored cost for it. Kitchen vanity is what I'm going to construct. I have also factored a cost related to that. Bestcom, I have showed 100 rupee cost, but I'm actually charging them 250, and I'll also collect it from the landowner. So I have done some arrangement in my calculations. Then this is a pass-through income that I'm collecting, which I'll have to incur because I'll collect here and I'll also spend. But since I've already factored it in my cost, this is my income. That's how my 7,000 rupees, 7,167 rupees is the base price, starting price. Against that, my construction cost is 3,820, but I can only sell 69%, so I have to derive what is the cost per square feet for me, which turns out to be 5,535. Now, depending upon what happens typically, you don't spend the construction cost in one shot, you don't sell also at one shot. So the construction, though I have calculated, I have already, you have to factor the escalations also. In my 2,500 construction cost and other costs, I have assumed the life of the project and derived it, and that's why I'm not calculated increase in the price or decrease in the price. But that's how you spend. Different phasing you do, and you spend cost at different approval cost you may end up spending now, JDA cost you may end up spending now, but other costs will be spent over a period of time. So I have kind of given this percentage as to when these will be spent. Then the sale price that I said, the starting was 7,167, but as and when I progress, I'm going to increase the price, and you can see that the price is gradually increasing. Using this, I have also kind of worked out that if I sell today, I can't collect everything. I'll be collecting it over a phased manner. So though I sell an apartment today, but the sale price will be collected over a phased manner. Accordingly, I have built the collection schedule. It's a huge model. What I'll straight away take you to the cash flow. What I've done is basically this is a monthly model, if you see, because sales and cash flows take place monthly. I have shown the collections monthly. I have shown the payouts that you are doing monthly. This refundable deposit, JDA, brokerage will be incurred initially. Construction will be spent over a period of the project. Approvals will be done initially. Site overheads initially. Consultants initially. Marketing over the sales phase. Maintenance at the end. Corpus at the end. BESCOM at the end. Corporate overheads is an assumed number. Selling cost is the actual thing. As and when you sell, you end up paying. Now, at the end of the project, it's a refundable deposit that I spoke about. I give it to the landowner, and once I complete my obligation, the landowner has to return this money. This money will come to me at the end of the last. At the time the OC is done, he will hand over me. I'll hand over all the units or the money that I have collected by selling the his share, but he will return me the refundable deposit. Basis that, I have calculated the free cash flow to the firm. I have also calculated tax. It is inbuilt into the calculations. Then I'm going to discount it by an appropriate discount rate, get the valuation done. Either I'll do it at an enterprise value level or I'll do it at an equity value level. I'll share this to explain this cell by cell will take a lot of time. So let me not spend more time on this beyond this. I'll be sharing this template. It will definitely be useful to you. You please go through it cell by cell. And if I'm also sharing my number post the end of the session, you can please reach out to me whenever you want. There were some questions on the JDA. Maybe let me not get into the calculation, but any theoretical aspects of it or a practical theory questions on that I can answer now. As somebody had raised a few questions. Can you please let me know if I have to answer that? And what is the question?
Basically, the CF method which you have discussed is basically based on the practical aspects. Because of your experience, I have seen that this is your practical experience, because this type of detailed working, only a person who have a real experience in the real estate budgeting and others can make this type of thing.
I would say that real estate is one of the easiest and the simplest sector. Those who have done valuations in other sectors, I used to never be a real estate expert. I was always a person like you guys, valuation expert, or at least decent knowledge on valuation, because I worked in consultancy firms where I used to carry out valuation of different sectors. Real estate, I stepped in real estate and started learning once I stepped in, and it took me hardly 6 months, because real estate, there are a few things that you need to know. Regulations are a little difficult. Once you understand regulation, you'll be much more expert. Once you know, it is like any other, I would say any other sector you can value if you understand that sector. Okay, shall I go ahead?
Yes, sir.
Okay, very quickly, like any other market method, I was telling you that you can always value a property based on the value what a neighborhood property is being sold at. So, using the same logic, comparable approach or comparable method has been presented to you. Here, what you do is usually you use this method when in case of a vacant land. And you are not sure what to do about it, whether a residential development has to be done or a commercial development has to be done. You're not sure about it. So what you do is you try to compare your subject property which you're valuing and compare it with other properties in the vicinity. Find out what is the price at which it got sold or are being quoted. Sometimes you don't get the sale price also, you only get the quoted price. So you believe that that could be the price, and then you do the analysis. Then there would be certain factors which would be differing from their property with your property. Let's say your property is close to the metro, you'll have a higher price for your property. Their property is a larger property, yours is a relatively smaller property. A larger property will get a discount, your property will get a premium. Your property doesn't have all the approvals in place, or the required zone approvals have not been taken, regulations have not been taken, then your property will command a lower value. So and so forth. You do an analysis, you actually build a matrix, and qualitative aspects of it are noted down, and you try to assign, not a very scientific method, but you try to assign certain premiums or discount as compared to the comparable property, and work out a final net premium or discount and apply it to the prices that were traded for the comparable property to your property, and work out the valuation. Very quickly, this is live example. This again, if you see, I think it's already 10. If you can give me 10 more minutes, Uttam, I'll be able to finish this.
Sure.
If it is okay with everybody here.
Sure, definitely. Please go ahead.
Yeah. So this is a comparable method. This is actually a property that I valued in Gurgaon. Sector 76 was in Gurgaon sector 76. I had a 2.79 acres to be valued. It was a vacant land, and no approvals were there time being. I mean, the basic approvals were there. It was a converted land, but still there are a few zoning issues to it. Now, what I did was I tried to compare several properties. I had 7-8 properties into question, but the most closest in terms of features wise, I took 2 comparables, and the per acre price there was 25 crore for each of these comparable. Comparable 1 was also 25 crore. Comparable 2 was also 25 crore per acre. Now what I do, 25 crore per acre. Now what I did was I looked at the size of my property as compared to other. Now the size of my property and comparable one is same, so I did not give any premium or discount. Whereas on the other property, was a bigger property, 5 acre. Then I thought that a bigger property will have a discount, because when you sell a big lot, you'll have to offer a slightly discount. So because that property is at discount, I have valued my property at a premium, and I've given a 5% premium to it. Title, all the properties had clear title, so I have not given any premium or discount. Zoning wise, TOD zone, transit oriented thing. So I gave a discount to both to my property, because they were under the TOD zone and mine was not under the TOD zone. So I gave a discount of 20%. The other 2 lands were still in agricultural status and had to be converted. So I gave a premium to my property. The other 2 property had a good access to a 90 feet road, whereas my property had a 60 feet access, and also there were certain road being still developed. So I gave a discount to my property of 10%. The neighborhood profile of the properties in comparison were better than mine, so I gave a discount to my property. Finally, the prices that I talked about were the negotiated prices. Whereas in my case, the negotiation would have happened, would initiate. So I gave a discount because these are, sorry, the prices of the property were quoted prices. So based on the quotation, definitely there would be a negotiation and there would be discount. So to that extent, I gave a 20% discount. Now all these percentages are all kind of qualitatively you decide, and every valuer could be different. But I worked out a net discount of 45% and 40. And the prices were 25 crore each acre. Applying this discount per acre was worked out to 13.8 crore and 15 crore. I gave a weightage of 50-50 each, and per acre derived was 14.4 crore. This I applied on 2.79 acres, and I derived a value of 40 crore for the total property. This is a live case in Gurgaon. I use the same property to value. I use another method to value the same property, and that was nothing but a residual method, which is another method. If you see the same property, if you can see the screen. This is another property. I'll quickly run you through the calculations and you'll understand the method. This is a residual method. What you do here is generally it is applied to a situation, to a land which is vacant, or to a development, a land which has all the approvals in place, and it is halfway done. Also, you might use this method. Or let's say I give you an example of Lee Meridian versus the best possible use. So alternative use of that property is possible. Again, many times instead of using a DCF, you use this method. Now, what I've done here is I have assumed. I gave some did some calculations basis the area. The total area is 2.79. This was in sector 76, as I said, and the possible development there was plotted development. So I calculated what is the total plot area, which was working out to 2.75 into 343,560, works out to 121,532 per total square footage. However, when you do a plotted development, you'll have to leave the actual area that you end up kind of selling will be only 35%. 1 second. You can see the screen, right? Yeah, you can see the screen.
Yeah.
Yeah.
Yes,
yeah. So the actual sellable area is only 42,536, which is around 35% of the total area. This particular land, there is FSI restriction that you cannot construct here beyond 1.5 times. So the total built-up area or a FSI that is permissible is 182,298 per square feet. Here you can sell it at 28,000 rupees. The typical thing about this method is that this method assumes that the development is already done and derives the sale value. If it is partially sold, then only the balance sales are taken into account. In this case, it was not sold at all. And then you start reducing the likely cost. So now to sell this at 28,000, you have to incur on the marketing cost of 5%. You'll have to spend on the development cost, which will be based on the total plot area, approval cost, which will be based on the built up area or the FSI. Then there would be some preliminary expenses. I have assumed here that if I am at a land stage and if I want to take some loan for doing all this construction, and basis this land alone, the interest cost that I might end up incurring is 14%. But depending upon the situation, it can be 10, 11, or 12. I believe that to sell the plotted area, I'll at least spend 3 years time. So I have factored 3 years period. And I believe that anyone who would like to buy this land would like to have a profit of 20%, both when he monetizes the land, also for the fact that that there are two types. One, I sell the land. Second, I'm doing a development activity. Both for the development activity as well as for owning the land, I would like to have a profit. So that would be around 20% on the development cost and on the land. Now, very quickly, if you see, this is a little interesting, though it's simple mathematics, but little interesting. I understand finance, but then when the first time I saw, I had to spend some time. Maybe I can explain you quickly. As I told you, 28,000 rupees per square feet. It is only on the sellable area, 42,536, not on the built up area, because I can sell only the land plot. So I multiply that to 28,000. But to sell this, I have to incur a marketing cost of 5%, which is on the sales price. So what I end up getting is 119 crore less 6 crore is only 113 crore. But this sale price is possible if I do a development. To do the development, what I have to do is I have to incur 200 rupees and this 1250, 200 rupees on the plot, which is that 1,21,532, and the 1250 on the total built up area. Put together works to 25 crore, 25.21 crore. Preliminary expenses of 10% of this, which is around 2.5 crore. Put together, the total development that I have to incur is 27 crore. Ideally speaking, I should have simply reduced from the sale proceeds this cost. What I'm going ahead and doing is, I'm saying that this 27 crore will be financed through debt, and I will incur an interest cost of 6 crore over a period of 3 years. But then I'll also be paying off that loan. So gradually it will fall down. So on an average, I'm taking 1.5 years and calculating this interest at 14%, which works out to 6 crore. So the total cost that I incur is 25 plus 2.5 plus 6, which is 33 crore. As a developer, if I'm spending 33 crore, I need a 20% margin on the development that I'm doing. So I have factored a 20% margin also. So my total cost that I'm assuming is this 33 crore plus 7 crore, which is 40 crore. This I'm going to reduce it from 113 crore. It ends up being 72 crore. Now, I was thinking that this is the land value when I initially used to look at this method, but you don't have to stop here. I'm willing to pay 72 crore only after factoring interest costs. I see, before generating 72 crore, I would buy the land, and because I have taken the risk on the land also. See, as a developer, I'm taking two risks. One, I'm buying the land. I want to earn on the land. Second, I am going to buy the land using again my equity funds or a debt. Assume that I'm going to use a debt, and that cost also I have to reduce. So from the 72 crore, I'm reducing. It's a circular reference. I'll be sharing this file. So out of the 72 crore, I'm assuming that I will be incurring interest cost, which is close to 19 crore. And I will be making a profit of 40 crore. So yeah, I have calculated the other way around. To be very frank, on this 40, it is 20% profit. On this 40, there is 14% interest for, let's say, 1.5 years if I effectively come. So for 3 years, if I am going to hold, because I'm buying, it is buying, so that will work out to around 17 crore. Here it is 19 crore because there is a circular reference based on the land. Again, the interest cost is being built. Now I have also calculated at 20%. Whatever is the balance left out, on that I'm going to incur. I will also so I'll reduce the risk that I'm ready to take, and the risk is if I'm going to buy land, I'll expect a 20% return for the risk that I'm taking. So I'll reduce the interest cost and the risk that I'm taking, and that's how I'm going to work out the residual value of the land. Just to put across, if you see the screen here, sorry for being really fast, but if you see the screen here, in the residual method, what I've done is generally I do it for a vacant property, what I've done is I've first assessed on the gross development value of the property. If already some portion of the property is sold, then I'll not factor the sales of that. But if it is not sold at all, in our case, I'll factor the sales value of everything. Then I'll reduce the balance cost that I need to incur, the total development cost, marketing cost, sales cost, consultants cost, interest cost. Then I'll also give a weight. I'll reduce a profit margin that the developer wants to keep because he's incurring on the construction cost and on the land cost. Whatever balance is left out is the residual value. This method is similar to the DCF method, but the only thing that you need to factor here is that I do not give escalations or discounting factors. I treat it as on today, and I use this. This is a little different way of looking at it, different from DCF. Here also I'm looking at the future sales and future costs, but I'm not discounting them. I'm not giving any escalations to the cost also. So having said that, these are the key methods. The next method is the land and building method. It is very, so basically, to put it simply, it is valuing a property. Sorry? Sorry? Okay. It's a land and building method. Here what you do is you value the property in two elements, one for the land and for the building. For the building, you follow the depreciated method like any other asset. What was the construction cost? And because it's a 10-year-old building, you reduce the depreciation out of it. Land, you can follow any of the methods that we discussed right now. It is also called as a physical method or a depreciated method. I don't have any case study to show this, but we have already done and discussed several other methods where you did the land value. Other two methods are actually not methods, but they are kind of thumb rule, quick calculations. These are not accurate mathematics, but these are like quick calculations. Value per gross rent multiplier. Like I told you that my rental is 10 crore and the property I sold it for 120 crore, so I got a 12 multiplier. It's only a thumb rule that you can apply, but these are not actually not exactly mathematical methods that you'll be using. Again, value per door, let's say a residential multi-family residential building is there, which is having 20 houses and it got sold for 20 crore. So per house is 1 crore. And you also have a multi-family house, which is 5 houses, and you apply 1 crore per house. So it's 5 crore. Again, it's a quick and easy way of calculation, may not be accurate because the multifamily having 20 houses might have a clubhouse which you may not have. Your house might have very high end renovations done, but the other house would not have. So it's a quick and easy way of calculating, but may not be the best method. I spent some time on this screen. I'll anyways be sharing this presentation with Uttam. What I've done is I have summarized the various valuation methods and the suitability of the methods. It's the same thing that I said. Capitalization method suitable for income generating commercial asset, which has a long lease. Term plus reversion is suitable where the lease is short, but the lease has been at a mark less than or higher than the market rent. DCF can be used for a variety of methods. You have to estimate the cash flow. Comparable method is generally used for a vacant land. Residual method is also suitable for a vacant land or a property which has the highest. Other alternative uses, like in case of Lee Meridian, we had worked out the valuation of the property using highest and best use. Land and building method is a valuation of a school or an industrial warehouse where the owner is occupying it and he knows that there is a land value and there is a depreciated building value. You can work out that. I'm sorry for being really fast at the end. Wanted to complete it. Was able to. Very quickly, I launched the poll and then I'm willing to take any questions also. Let me spend 2-3 minutes on the poll and then I'm happy to take any more questions if time permits. Rent capitalization method. What is it suitable for? I already kept the screen open for you. I'm sure you're not able to see the table. So yeah, most of you have answered correctly. Rent capitalization method is suitable for a real estate which is generating rentals which are equal to the market rent. Yeah, I'll end the poll. Maybe next question. comparable approach of valuation of real estate is usually applied to. Once again, share results. Yeah. Okay. Comparable approach of valuation of real estate is usually applied to.
In the meantime, if any one of us has any questions, probably we can take up the questions while the poll is on.
Yeah. So most of you have answered it correctly. I'm happy to answer any questions. I have one more poll question, and if you want to start the question is also fine. I can answer that while I launch the poll.
How do you factor in age of the building when you are considering real estate from rental property, the rent capitalization method, for instance?
No. There are definitely you will be knowing you'll be having the books of account where you can see the age when it was constructed. One is that, and second, there are experts like we make use of experts like engineering experts that we hire. More than the age of the, as I told you, sometimes the building would be aged, but a developer like Embassy or Prestige, they also on a regular basis spend on the upkeep of the building, whereas there could be other developer who may not be spending. So I would also make not just the age based on the real age of the building, but I'll also appoint experts like Synergy who are technical experts. I'll appoint them and find out how is the condition of the
residual life.
The residual life. So I'll remaining residual life. Yeah. So I'll make use of those experts and find that. Last I can one second. Maybe I'll put the last question and then we can go ahead on more questions. Yeah. So a comparable approach is mostly suitable for vacant land. Last question. Cap rate of a property represents what? Read this question carefully and try to answer. Yeah, any more questions while the poll is on? Maybe I'll tell you that look at it as EBITDA. Please look at it as EBITDA. And you should always treat NOI as EBITDA and apply cap rate on that. You will not go wrong, because it was confusing for me also when I first heard about applying cap rate. Some of them are giving different answers, but treat it as EBITDA, you will get to know. Any more questions?
Hanuman, so nowadays what we are hearing from some real estate, from some consultants in real estate, is that the housing sales are starting to pick up once again.
Yeah.
And I think that builders have started new projects. They've restarted getting new projects in place and so on. So now in this scenario, now the key in this is what is the expected appreciation in property prices, and general economic scenario is something which affects that probably. It's not only the specific real estate, which is, let's say, Mumbai may be different from Bangalore, But let's say general economic conditions are such that there is a lot of money flowing into the country. There is an appreciation in general in a lot of assets. So how do you factor this into valuation of real estate? The question is basically economic scenario in general for the country. How do you factor?
So I think you put yourself on mute, Mr. Abraham. Yeah. Sorry, I lost the last part of it.
The general economic conditions in the country which are affecting real estate prices or inflation, how do you factor that into the model?
So best way is to look at the DCF method. Now, when you look at the DCF method, if you understand the economic scenario of the market, you can accordingly project it. You rightly said that, see, when I'm valuing a commercial asset versus a residential, today I'm going to factor the economic scenarios. One, residential, you're right to say that residential sales have actually picked up. Today, a guy who was staying in a one, and obviously he should be having a job. There are people who are losing jobs also, but this is not going to be forever and ever. So this is a current situation. You cannot say that, okay, you cannot value the businesses like it happened on March 24th, 2020, when the market went down to 7,800 points. Today it is back to 13,900. Maybe today also it is on a very, very high side. It should be closer to 12.5, 13,000 kind of number. I'm talking in terms of the Sensex and Nifty. But look at the future. The future looks better, and it looks better for residential market. There are people who are staying in 1 BHK and are moving to 2 BHK. Will be extended and will today people are kind of moving towards flexi space that being taken up. So there would be somebody who was a Microsoft who has taken let's say 10 million square feet on lease, might end up taking only 5 million square feet on lease, and will tell his employees that, okay, you can come only 2 days in a week to the office, need not come all the days in the office. So to that extent, you have to factor that while you value a commercial property. If somebody like Embassy says that I'm going to keep on leasing property and keep on building property, then as a valuer, I would not. I will apply a higher discount rate while I value. I will factor all these. I will assume that the leasing will take place slowly. In Bangalore, before COVID, every year 10 million square feet was getting leased. Will it continue to be, when I'm saying 10 million new areas getting leased, new development coming up and new area getting leased, releasing is happening, the new leases that I'm saying. But now the situation is that the existing leases itself are getting vacated. Manyata, if you say, take example of the Hebal side of commercial development, the rentals there used to be 60-70 rupees. People are either trying to walk out of the leases if there is no lock-in, and they are moving ahead to places where the rents are less than $1. So the one are expensive leases, probably they may not continue to get leased at that rate unless they bring down the rentals. And the ones which are cheaper properties in the suburbs, they will get higher valuations in terms of commercial. In terms of residential, the residential sales, there is one, nobody knows the right thing or the wrong thing, but there are some people who believe that there will be more sales that will pick up in tier 2, tier 3 cities because work from home will be there. Some believe that work from home cannot be forever. There could be flexi staffing where you need to come to office 2 days in a week. So within the cities itself, there will be pickup in the sales prices of the residential. However, the requirement now the socio requirement, the social aspects of the market also is important now. People will stay more in houses, so they would want one more extra room. I moved from a smaller house to a bigger house because I wanted this. Today we are attending a session. Everybody's sitting at their houses and attending this, and this is possible if you have one separate section. So there are people who are moving to houses where you have a extra half room for office as well. So the demand will change based on various conditions, and you definitely need to factor it. And you can best method to use is the discounted cash flow method. However, you should always note that like any other method, like any other sector, garbage in, garbage out is DCF. If you put in the right stuff, you'll get the right result. If you do not factor all the stuff, then the end result may not be appropriate. But definitely you need to factor all the socio-economic and political scenarios that are prevailing in the market and the various factors that we discussed and work out the valuation.
Thank you.
Any more questions? So the cap rate, as I told you, is the expected rate of return without considering the appreciation or depreciation of the property. So my property will keep on growing by 5%, 6% every year. Do not factor that in your cap rate. The cap rate only talks about the return from the rentals. So it's a rate of return of the property excluding the appreciation or depreciation of the property. If there are any more questions, I'm happy to take. I'm done with it. 1 second, I'll just show the last screen with my details. 1 second. Can you see the PPT, Uttam? Yeah.
Yes.
I'm not able to go to the next slide. We did this. I'm done. These are my details. I'll be happy to be connected to all you experts here. And I'm happy to work on any assignments that you feel we can work together and answer your questions also, or any clarifications you need, whether on real estate or any other sector. If I have a decent knowledge on that, I'll be willing to share that. And definitely, I'll also like to get connected and get your help whenever required. I'm done with it. If there are more questions, I'm happy to answer.
Yeah. Yeah, I mean, that should be good. Shilpaji, do you want to propose the vote of thanks?
Yeah.
Yeah,
Yes.
Thanks, Shilpa.
Yes, Uttam. Thank you, Uttam. Thank you, Hanuman Joshi. It's a wonderful session where we have, what are the problems and what are the challenges we face in real estate valuation, especially because if you see any valuations like we do, like company valuations or IPC valuations, in most of the cases, real estate will be very crucial for us, because sometimes the companies will be having very much huge land will be there. Again, whatever these properties will be there. And it is very for net asset value method. It is very useful for us. And here the challenges is when we are doing under IBC, maybe we can't use the highest and best use method, which we don't use usually. Wherever we are getting the reports from the real estate valuation, we see only the fair value, means the market value of the land in that in that locality. Like governmental rent or market value, whichever is higher, they will give. That's why we have a little what you call disconnect. What is this highest and best use, where we are not seeing in a real valuation report. Even when you are doing company valuation also, usually the valuers are giving only the market value. They are not taking any highest and best use. But this method is very useful for us, when we are seeing that DCF method. I don't think so, in most of the cases, they are doing DCF. Maybe if investments are coming, they are looking under DCF method. And it is very giving lot of insights into the real estate valuation. And thanks for your time, and you have taken us entire process of starting from the definition, the floor space index or built-up area, super built-up area, everything you have given. And definitely, we will come back to you for any any chances for evaluations and thank you, Hanuman Joshi, once again, and I really appreciate for your efforts and the presentation, the sheet which you covered and the which you poured. Thank you very much.
Thank you, sir. What I'll do is I'll send the PPT and the Excel to Thumb, and he can also share it with everybody. And I'll be happy to answer any questions going forward. Also, please reach out to me. And thanks a lot for this.
Thank you everyone for your participation and advanced Happy New Year for everyone.
Happy New Year, everybody.
Thanks a lot. Pleasant evening. Thanks. Bye.
Bye.
Thanks.
Bye bye.